what I thought I would do is, as a broad brush approach, share with you some of the pros and cons of incorporating a property portfolio. But if you're thinking about incorporating, I would say to you, the first thing you need to do is to make sure you can demonstrate you have a business. And if you look at the Elizabeth Moyne Ramsey case, that will give you an indicator, give you an indication, in fact, of what constitutes a business. So generally speaking, you've got to have a property portfolio. You've got to have, you should be spending 20 or more hours in your business a week. And ideally, your property should be managed by you and not a letting agent. So some of the pros of having a limited company are, and the most obvious one, which is why most people want to incorporate, is you can claim 100% of your interest costs. That's one of the obvious benefits. Above and beyond that, if you have let's say a sole trader or a partnership business, a property business, if you incorporate and you have a business and you can demonstrate you have a business, you won't have to pay capital gains tax when you incorporate, because you claim Section 162 incorporation relief. If you are a partnership and you incorporate, you won't have to pay stamp duty, land tax, as long as you meet the rules. But if you have all the properties in your own name and you incorporate, you can escape capital gains tax. If you have a business, you won't be able to escape the stamp duty, land tax. Above and beyond that, one of the biggest benefits of incorporating, in my opinion, depending on the value of your properties and the equity, is when you move your properties from your own name into a limited company, you have an uplift in the base cost of those properties. And I've covered that in some detail in the book that Yoko referred to, which is the Property Investors Tax Guide. So look at that and think about the increase in the base cost. But of course, the base cost is also determined by the equity and the value of the mortgages. So you need to tread very carefully in working that out. Above and beyond that, another benefit is if you have a limited company, you can control how much money you take out. So you can take out a salary, which goes up to your personal allowance or to your national insurance threshold, and the rest of the money you can take out by way of dividends. That can be more tax efficient and usually is. One other point that I've already covered for you, which of course is that if you have a limited company, you've got limited liability. To some people that's important, whereas obviously if you're a sole trader or a partnership, you've got unlimited liability. And the final point I want to cover in terms of a benefit of incorporating is you can then look at inheritance tax planning once you incorporate your property portfolio. So those are some of the benefits of incorporating. There are other benefits too. Some of the things that you need to be aware of when you incorporate, so some of the cons are when you incorporate, you'll incur legal fees. So include those into your calculations. You'll also obviously have to pay for valuation fees, especially if you've got mortgages. You might have to pay a higher rate of interest, so consider that. And sometimes people, I think, without fully considering all of the financial implications, are perhaps told by somebody that they'll have to pay more tax because they can't claim all of the interest as a sole trader or a partnership. They then end up jumping out of the frying pan into the fire. They end up incorporating, and then they find out the increase in the interest rate negates the tax saving on incorporation. So make sure you figure that out. Now, interest rates are becoming more competitive, and there are more lenders now who are offering mortgages to limited companies compared to say 4 years ago. So that is becoming more competitive, but still consider that when you look at the numbers. And then of course, if you have mortgages, you'll have to pay arrangement fees. Also obviously think about the stamp duty, land tax implications, and also bear in mind that if you have property in your own name, if you sell that property, you have your annual exemption for capital gains tax purposes. If you move those properties into a limited company, you are going to lose the annual exemption, because companies do not have an annual exemption and companies do not have a personal allowance. that only applies to individuals. And if you incorporate, of course, you lose some of your privacy because your information is publicly available on company's house. So if keeping things private and confidential is a key determining factor for you, then perhaps incorporation might not be something that you want to, or that journey that you want to embark upon. I can see a question here, Yoko from Trang, I think it is, and it says, when applying for a mortgage under a company, director has to be the personal guarantor, or is it still down to the director's liability? So I'm not too sure what the question there is, but if the question is, will you have to give a personal guarantee, then the answer is it depends on the lender. So some lenders will ask you for a personal guarantee, some might not. So, but if you do give a personal guarantee, then basically you've lost the benefit of limited liability, because then you are personally liable. So where possible, avoid giving a personal guarantee. I know that's easier said than done. If you can, good. If you can't, then you are going to lose the limited liability benefit. If anybody has any other questions, please type them in there. Something else which I know I'm running through this quickly, but the point of this conversation really is, like I said, to raise your awareness rather than to do a deep dive. But I have promised Yoko that I will come up into the Northwest at some point next year, so then hopefully we can cover this in detail.